Okay, so we spoke about recognition criteria. Now we're going to talk about the recognition exceptions. So particularly relevant when you have a DTL. So there are three recognition exceptions that you can see here. One is goodwill, initial recognition exception, and those for investment. So for goodwill is simple. You see goodwill, don't recognize anything. However, if you separately record other intangibles like customer relationships, brands, trademarks, customer contracts, you do need to recognize a DTL on them. And normally they trigger a DTL on acquisition because they are not depreciable for tax purposes. The next one is the initial recognition exception and the one for investment. So let's talk about the one in the middle first. So this one, initial recognition exception does not apply to investments because it has its own exception. So it says here that don't recognize a DTL if the transaction is not a business combination, which means the purchase of a business or an entity with a business. And when you enter the transaction, there's no impact on accounting and taxable income. Okay, and then the third one at the time of transaction does not give rise to equal taxable and deductible temporary difference. So this basically says you need to recognize your right of use assets, or you cannot apply initial recognition exception to right of use assets. So to demonstrate the initial recognition exception, let's look at the purchase of a car costing 200,000. So here your carrying amount in the balance sheet is 200,000. Unfortunately, your future deductions limited to the car limit, and that has not been updated. It might have changed. Let's say it's 57,581, and therefore I have a taxable temporary difference of 142,000. And prima facie, I have a DTL. So let's look at whether the initial recognition exception. One, when you bought a car, was it a purchase of a business? No. So I think satisfy that one. At the time of the purchase of the car, at that point in time, was there an impact on profit or taxable income? No, because it's a balance sheet transaction. I take the second point as well. So therefore, I satisfy the initial recognition exception. I don't have to recognize a DTL. However, in the notes to the financial statements, you note that you do need to disclose the amount of deductible and taxable temporary differences, which you do not recognize. So remember, the third one is relating to investments. So it applies to investments in associates as well, and joint ventures. So here, you satisfy the exception if the entity controls when dividends are paid and when you intend to sell that investment, so you have control of it. And it's probable that you're not going to get unfranked dividends, or the investment will not be sold in the foreseeable future. So if you can satisfy those 2 points, then you potentially can apply the initial recognition exception to that investment. We spoke about unrealized losses, which basically say you need to be able to demonstrate that you sell the investment in the near future and you have something else to sell on your balance sheet to apply those capital losses. Yep. Okay, so finally, I note that, and you'll be aware of this, once you finish the calculations, you need to then prepare your tax note, where you need to disclose the major components of your tax expense, reconcile your accounting profit multiplied by the tax rate and your tax expense, and also break down the components of your deferred tax asset and liabilities. And this is basically, if most of you are CTS, use our CTS software, and this calculation is automated for you.